All right, welcome back. We're getting to the end here in the main segment of the chapter. You may remember when we talked about direct materials variances, I mentioned that what we did only worked because the quantity purchased and the quantity used were the same. The quantity variance is computed with the quantity used, and the price variance is based on the quantity purchased. And as long as those are the same, we can take the normal three-column approach and all is well in the world. But when they're different, we need to use two separate middle columns. So Glacier Peak Outfitters has the following direct material standards. Last month, 210 kilograms of fiber fill were purchased at a cost of $10.29. We used 200 kilograms to make 2,000 parkas. So what we're going to have to do is do actual quantity times actual price, actual quantity times standard price to get our price variance. And then we're going to have to do a separate middle column, actual quantity times standard price, and standard quantity allowed for actual production times standard price to get our quantity variance. And the reason we have to do this is the quantity purchased and used are different. The price variance uses the quantity purchased. PP, price purchased. The quantity variance uses the quantity used. QU, quantity used. So with that said, let's fill in the blanks here. We purchased 210 kilograms, so that's the actual quantity purchased, and we spent $10.29. The standard price was $5. So that's all we're going to need to get our price variance. But for the quantity variance, we use 200 kilograms. So notice that AQ is different now. So we're going to use 200 kilograms for our quantity variance. The standard price is still $5, and our squap is the standard allowed per unit of 0.1 times the actual parkas we made of 2,000. So that's going to come out to 200. So the process is very similar, but we're going to need two separate middle columns to make it work. This only applies to direct materials variances, and it only applies when the quantity purchased and the quantity used are different. The rest of it is done the same. So to get my actual price, I'm going to take my $10.29 divided by 210. That gives me an actual price of $4.90. And then we do out our math. 210 times 5 is $10.50. And $10.50 minus $10.29 is $21. So we spent $10.29. We were allowed to spend $10.50. We spent less. That's a favorable variance. Also, $4.90 is less than $5. To get my quantity variance, 200 times 5 is 1,000. And then $200 times 5 again is 1,000. So here our quantity variance is 0. So we don't need to come up with favorable or unfavorable because it's 0. But the one thing I want to point out is we can't do our little check where we add our price and quantity variance to get the difference, because you'll notice 21 plus 0 is obviously 21, but the difference between $10.29 and 1,000 is 29. So whenever you have the PPQU situation where the quantity purchased and the quantity used is different, you have to do a separate middle column, and you can't do your double check because that middle column is different for each variance. Again, the price variance uses quantity purchased, PP, and the quantity variance uses quantity used, QU. So be on the lookout for direct material problems and make sure the quantity purchased and the quantity used are the same before you just go through and do the three-column approach without thinking. Here it is all typed. Again, notice we have two middle columns. The price variance is based on the quantity purchased, and the quantity variance is based on quantity used. And again, this only applies to direct materials. It's the only variance where we have to think about this. So let's wrap up the chapter by talking about some advantages of standard cost. Standard costs are key elements of management by exception. Management by exception is when you take actual results and compare it to the budget. So the standards provide us a budget on a per unit basis, which allows us to do this management by exception approach. Standards give us benchmarks to promote economy and efficiency to get better effectively. Standards can simplify bookkeeping because we could use the standards in our bookkeeping, and it can also support responsibility accounting systems. In other words, it helps us hold managers accountable for the things that they have control over. What are some problems? Standard cost variance reports are usually prepared on a monthly basis and may contain information that's outdated. So it might be too late to make changes as a result, at least in the current month. Variances can be misused, and you can yell at one employee when it's not their fault. For instance, you could say to the production manager that they did a crappy job because they had an unfavorable quantity variance, when in fact it's because the purchasing manager bought shitty goods. So you got to be careful at the way you use these variances. And labor variances assume that the production process is labor-paced and that labor is a variable cost. These assumptions a lot of times are invalid because a lot of companies focus on automation more than employees, and the automation is essentially fixed as opposed to variable cost. Some additional issues: just meeting standards may not be sufficient. We want to continuously improve and make our business better. In some cases, a favorable variance can be bad or worse than an unfavorable variance, because we could have a really great favorable price variance because we hired unskilled workers, as an example. Well, that's not a good thing, is it? And excessive emphasis on meeting standards may overshadow other important objectives like maintaining quality, on-time delivery, or customer satisfaction. So if we focus just on meeting quotas, we could lose sight of the big picture. That's all that means. And that's it for the main component of Chapter 10. But there is a appendix that we need to go over, or a supplement, which will cover the only product component that we didn't discuss, which is fixed overhead variances. So don't forget, we need to cover that as well. It'll be on the exam.